Economics for Beginners. Chapter 6. The Theory of Banking. 1. The word bank originated in this way. In the year 1171 the city of Venice was at war both with the Eastern and Western empires, and its finances were in a state of great disorder. The Great Council ordered a forced loan of 1%, to be made from all its citizens, and promised them 5% interest. Such a loan is called Monte in Italian. At this period the Germans were masters of a great part of Italy, and the German word bank was used as well as its Italian equivalent Monte, and was Italianized into banco, and the loans or public debts were called indifferently Monte or Banchi. Commissioners were appointed to manage this public debt, to pay the interest upon it, and transfer the stock. The state of Venice took the money, which it appropriated to its own purposes, and gave its citizens in exchange for it credit, or stock certificates, which they might transfer to anyone else. This was the essential feature of banking, and those traders are called bankers who buy money from their customers, and in exchange for it give them a credit, which they can transfer to anyone else. 2. We must now explain the mechanism of banking, and show how it augments the capital of the country. Suppose that the customers of a bank pay in 10,000 liters to their accounts. Then the money so paid in is a mutuum, it becomes the banker's absolute property, and in exchange for it the banker creates an equal amount of credit in his customer's favor. That is, the banker buys this money by creating an equal amount of rights of action against himself, and his accounts would stand thus. Liabilities, deposits, 10,000 liters. Assets, cash. 10,000 liters. These rights of action, which the banker so created as the price of the money, are in the language of banking termed deposits. The money itself is termed an asset. The customers can either demand money in exchange for these rights of action, or they can transfer them to anyone else. But although the customers may demand payment of their rights at any time they please, they would not pay in money to their bankers if they meant to draw it all out again immediately. Nevertheless, some will want to draw out part of their funds, but if some want to draw out money, others will probably pay in money, so that in ordinary and quiet times a banker's cash will seldom differ by more than 1/36th part from day to day. Hence, if a banker keeps 1/10th part of his cash to meet any demands for payment that may be made, that is ample and sufficient in all ordinary times. 3. A banker of course makes no profit by his customers paying in money. On the contrary, he often loses, because he often agrees to pay interest for it, and consequently he must trade with it in order to make profits. A banker trades in this way. He sees that 1,000 liters is sufficient to bear liabilities of 10,000 liters. Consequently he argues that cash to the amount of 10,000 liters will bear liabilities to several times its amount. The most eligible mode of trading is to buy or discount commercial debts in the form of bills of exchange. A banker, seeing that 1/10th in cash is sufficient to support his liabilities, buys perhaps 40,000 liters of commercial bills, and he buys these bills exactly in the same way as he bought the money. He buys them by creating credit or rights of action against himself. A banker invariably buys or discounts a commercial bill by writing down the amount of it to the credit of his customer, and at the same time he charges him the discount. The credit he creates against himself, or places to the account of his customer, in buying a bill, is also called a deposit, equally as the credit created in exchange for cash. Supposing the rate of discount was 4%, and the bills at 3 months, then the discount on this sum would be 400 liters. Consequently, in exchange for the bills to the amount of 40,000 liters, he would create credit against himself to the amount of 39,600 liters. Hence, just after purchasing these bills his accounts would stand thus. Liabilities, deposits, 49,600 liters. Assets, cash, 10,000 liters. Bills of exchange 40,000 50,000 liters. By this process the banker has added 39,600 liters of credit to the previously existing cash. From the foregoing exposition of the business of banking it is seen that this is the definition of a banker. A banker is a trader who buys money and debts by creating other debts. Thus the essential and distinctive feature of a bank and a banker is to issue credit payable on demand. and this credit may be put into circulation and serve all the purposes of money, and by so much credit as the banker can maintain in circulation over and above the quantity of cash he retains, he practically augments the capital of the country. Few persons probably have any idea of the stupendous superstructure of credit created by the business of banking. An eminent authority has calculated that in the United Kingdom there are about 800 million litres of bank credits, and these perform the function of so much gold. Nor probably are many persons aware of the immense consequences produced by banking. One of its consequences is that it has tripled the value of land. Before the introduction of banking, the usual rate of interest was 10%, but the bankers, being able to create so much credit, which had exactly the same effects as money, were able to reduce the rate of interest, until it may be considered to be at an average about 3%. And thus the value of all the land in the kingdom has been tripled. 4. The banker, having created these credits, or rights of action, or deposits, his customers might utilize them in two ways. 1. The banker, if his customers wished it, gave them his promissory note for such a sum as they pleased. 2. The customer might write an order to the banker directing him to pay such a sum as he had credit for, to anyone else or to bearer. These paper documents neither created nor extinguished a liability, they merely recorded it on paper for the convenience of transferring it to someone else. London bankers continued to issue their own promissory notes till about the end of the last century, but about 1793 they discontinued this practice, and since then their customers can only circulate these bank credits by means of cheques. But bankers were never prohibited from issuing notes till the Bank Charter Act of 1844. 5. Cheques being the only means the customers of a London banker have of operating on their accounts, we have now to show the different effects which may follow. 1. The actual money may be drawn out. If so, the banker's liability is extinguished. This is a resale of money to the customer, and the banker buys up the right of action against himself. 2. The credit may be transferred to the account of another customer in the same bank, and consequently the payment is made without the use of any cash. 3. It may be paid into another bank, but as all banks do business in the same way, if the bank A has claims against the bank B, it is probable that B will have about an equal amount of claims against A. If the claims of the two banks are equal, the cheques or orders are exchanged, and the credits readjusted to the accounts of the different customers, without any payment in money. If it should happen that the claims of all banks against each other exactly balanced, any amount of business might be carried on without requiring a single coin. If they did not balance, it used to be the custom to pay only the difference in coin, but by an ingenious arrangement the necessity for coin is now dispensed with in all cases. Banking is thus a species of insurance. A banker might be called upon to pay all his liabilities at once, just as all the houses insured in an office might be burned down, or all the lives insured in an office might drop at once. But all insurance and banking is based upon the expectation that these events will not occur. A banker multiplies his liabilities upon a given basis of specie, and keeps by him a sufficient amount of cash to ensure the immediate payment of all claims which are likely to be demanded of him. If an unusual demand comes upon him, he must dispose of some of the securities he has bought on cash credits. 6. We will now give an example of the use of credit which will display its powers in a very striking light, and to which the greatest part of the prosperity of Scotland is due. Bankers use their credit in the operations just described to buy commercial bills which arise out of the transfer of commodities, and it has been shown that they create credit to several times the amount of cash in their possession. The Bank of Scotland, which was founded in 1695, began to issue 1 litre notes about 1704. In 1727 the Royal Bank was founded. In the very contracted sphere of Scotch commerce at that time there were not sufficient commercial bills in circulation to exhaust the credit of the banks, and the Royal Bank devised a new method of getting its credit into circulation. It agreed upon receiving sufficient guarantees to open credits in favour of trustworthy persons, all advances being made exclusively in its own notes. A cash credit is, therefore, simply a drawing account, created in favor of a customer, upon which he may operate in precisely the same manner as upon a common drawing account. paying interest in the debit instead of receiving interest on the credit. It is thus an inverse drawing account. These credits are extremely useful to all persons in business, or in commencing a profession which requires a certain amount of capital. Every person in business must necessarily keep a certain amount of ready money by him, to answer immediate demands for small daily expenses, wages, and other things. This, if invested in business, might produce a profit of 15 or 20%. One object of a cash credit is to furnish the trader with the convenience of a small amount of cash upon paying a moderate interest upon it, and to allow him to invest the whole of his own cash in his business. Several professions require a certain amount of ready capital to start with. In England, those who enter such professions must have the actual capital. In Scotland it is done by means of a cash credit, guaranteed by their friends. These credits are granted to all classes of society, to the poor as freely as to the rich. Everything depends upon character. Multitudes of men who have raised themselves from the humblest positions in life to enormous wealth began with nothing but a cash credit. The operation of these cash credits is immensely extended beyond commerce, and their advantages are more openly and strikingly displayed in the prodigious stimulus they have given to agriculture in Scotland. They have indeed been the principal means of making it what it is. Scotch farmers have almost invariably 19 years leases, and, where they are given for the express purpose of reclaiming land, frequently much longer. The farmer desirous to effect improvements, on the security of his lease and the guarantee of his friends obtains a cash credit. With this advance, pure credit, he reclaims the land, employs the people, reaps the harvest, and pays off the loan. All public works of every description, canals, railroads, roads, bridges, docks, are all created by means of these cash credits. In all these things we see the nature and the power of credit. If they were created by means of money, that would have been the accumulation of the profits of the past. If they had been created by means of money, they would have replaced the money expended upon them. But there being no money, the banks plant their branches in every direction and advance an equal amount in their own yield notes, and these are the present value of the future profit. When the profit is realized it redeems the credit, and the result of the operation is exactly the same whether it is effected by money or by credit. And thus we see that credit is productive capital exactly in the same way and in the same sense that money is.